Welcome back. It's another stock purchase video. We figured we'd tell you right out the gate what we purchased this month, and it was NVIDIA.
What? Wait, no.
Wait, no.
What? What? I'm just kidding.
Yeah, we listened to all the trolls and we thought,
You guys are right.
you got it.
No. We bought three this month: Kimberly-Clark, Johnson & Johnson, and Devon Energy. We wanted to say it right out the gate, so there's no anticipation, no skipping ahead in the video or anything. That's what we bought. Now we need to explain why.
The long story there. So we have a list. Everybody sees the spreadsheet. We bring it up every month. The spreadsheet is the companies that have made the list. There's a whole mess of companies that we look at that don't make the list. And when you see the spreadsheet and you look at it and you wonder, well, why those companies? Well, it has to do with how we balance our portfolio, and it's specific to the dividend-induced portfolio. So what you see in the list is what we believe is a good weighted average for that portfolio in itself.
So these are the three that we purchased. Do you agree, disagree? Comment below. If you don't want to comment, then leave your favorite emoji, because engagement helps us out.
If you see the spreadsheet, yeah, we pull it up here. We've got a bunch of companies on the list that are all extremely very Dow-oriented companies. These are dividend aristocrat style companies. So in the purchase, we bought 1,000 of Kimberly-Clark, $2,500 of Johnson & Johnson, and only 500 of Devon. And there's some weighted averages for that, and there's a reason for that. So to get to that reason of why we bought the companies, we first have to go through the list and explain why we didn't buy the other ones. So first on our list is 3M. This is a company we have in the portfolio, and this company had just recently settled a lawsuit against the United States military for their masks. And we had them at the time because they look good. We still have that company. We're not selling it, but we're not very optimistic about it. Why? Well, look at their liabilities. And when people look at the spreadsheet and they go, well, do you use this as gospel? No, we do not use this as gospel. We use the spreadsheet as a guide to cover and reinforce some of the decisions and some of the news articles that we see that are out there. So if we have a whole bunch of information about 3M, this just helps reinforce it. It does not make the only decision for us.
Right. It's more of a litmus test. These are the values that we look at first to see, okay, do we look further into it, or these make it completely horrible to look at. We don't even need to go any further.
Right.
It's a time saver.
Or so we think.
Right. We could be completely wrong.
So on the list, the first one is 3M. The liabilities went up by a lot. There's also some discussion about whether or not they can afford to pay their huge dividend. I don't think that they're going to be able to pay what they're paying right now. Some of that's reflected in the depressed stock price. So we just passed over that one for now. We're not buying more. We're not selling it either. Next one on the list is Chevron. And Chevron, holy crap.
They got the money.
They got the money. I mean, there's 600% net income increase over 5 years, and they're spending all of it. Like all that money comes in, and it's all gone.
Tom, I love how your comment on this one is the deep pockets but expensive all caps tastes.
They're just buying stuff. I mean, there's a big acquisition they're making with Hess, and I know ExxonMobil's making a counter offer, and then the Feds got involved, and they're like, hey, we want to see the filings on this. But that's beside the point. I mean, when you see a company that has that kind of income, and then they're like me, they've got that kind of expensive taste, like they shouldn't be spending that much money. And if you look on the sheet here, you can see some of that reflected in these basic numbers. Now, again, these are just the basic numbers. But because of that, we have both Chevron and ExxonMobil in our portfolio. We try not to get over two in a specific sector, but because of what's showing up right now, this quarter in the spreadsheet, we're just waiting on that one. If we move on down the list again, we've got Colgate. I have Colgate stock. I like Colgate. I like toothpaste. I like, clean, shiny teeth or whatever. But, So Colgate stock, things look good. This company looked good. The financials look good until you went to the ticker symbol. You looked at the chart, and they are at their 52-week high.
We don't like to buy things at their 52-week high because, generally speaking, it's not going to break out and go 50% higher.
It's almost like we're buying it at a premium, right?
Yeah, cost basis is really high on that one. There's another number on here. If you look at the net income, the negative 14,000%, that's not actually the case. That's just timing. Like some quarters they don't make a lot, and other quarters they make a whole lot. Either they have a tax payment or they They pay off something on a not a monthly basis or like a semi-annual basis, and then that just greatly deflates these numbers or inflates them depending upon what quarter you happen to be in.
And that's why this is a guide and not gospel. So when you see something like that, you red flag, you go in and look at, okay, the first quarter that we look at and the last quarter that we look at, there's a huge disparity. Then you go in and look at why.
That's true across the board with like earnings per share, price to earnings ratio, all the metrics that people use. They're guides. They're not the only piece of the story.
And we don't use just one metric, like the PE ratio. We use multiple, but one metric could tip it over to a buy or a sell or not even look at.
So with that said, the next one on our list is Devon Energy. So Devon we have in the portfolio. We only had $400. The original portfolio was based on $400 a month. So we decided to double that with a $500 add to that to balance out the portfolio. Not because we love the stock and not because we hate the stock. The numbers were kind of in the middle. And if you looked at their net income over 5 years, it looks amazing. Some of that has to do with the market cap. So the other part of it, when you look at their cash flow over the quarterly basis and the 5-year basis, you're going, oh my God, Tom, why would you buy that stock? It's 60% down on their cash flow. Cash flow doesn't tell the whole story. You hear the thing, cash flow is king. Yeah, that's true. But Devon is a company that we originally bought, had paid a huge dividend. We said they're going to cut it. They cut it. The share price is now it's just kind of sitting towards their bottom. Do we think that they're going to go up? There's a lot of talk that Devon's going to increase. Well, we're not as confident about that until we see more I-9 reports that show more positive net income numbers. So that less volatility there. When we see that, we'll probably add more. But right now, we just needed to balance out the portfolio a little bit more in that sector. So we just added $500 to that one.
I generally want to see the Devon acquisitions and investments actually start to pay off. All the money that they're spending to improve their company.
Yeah, take note, Chevron. So next one on the list is DuPont. I want to love DuPont. I had DuPont for many years. They used to be the 8th largest company in the world. In fact, Biden talked about it in his State of the Union address.
And they used to be a darling of the stock market.
But they're still shrinking. They're still shrinking. Why? Stop shrinking. DuPont, when you look over 5 years, not the quarterly basis, they don't look great. The quarterly numbers are starting to look better. When they look good enough at a good entry point, we'll jump in then. But right now, they weren't there. They just weren't there. So next on the list is ExxonMobil. These guys, well, they're an oil company. I mean, do you really need to know about what an oil company does?
Yep.
You do?
No.
Oil products. So ExxonMobil, they look a lot better than Chevron. So if you're weighting the two in your personal portfolio, right now ExxonMobil looks a little bit better than Chevron does. That's just right now. That could change in a few months. But as far as like buying them in our portfolio, they didn't seem like a good time to jump into them. We bought them recently. They're already a pretty heavy sector in our portfolio. So as far as weighting goes, we don't want to add more to that.
I was going to say, we already own a lot of it that is weighting down our portfolio. So.
Yeah, we don't want to be lopsided. So no Trump mullets here. Next one on the list, International Paper. I've been watching these guys for years. And they can't, I think they're at the bottom of their glut. I mean, or their rut, whatever you want to call it. These guys are not, financially, they went through a problem when COVID hit. The schools stopped ordering paper. Everybody panicked. The stock went way up because they found out that they still ship 40% of Amazon's products. And the schools continued their orders, everything looked good, and then all of a sudden people stopped ordering from Amazon as much as they used to. So then International Paper went down. They also have issues with their union. There's a whole bunch of stuff going on with International Paper. Why do we care? Well, because it's a paper products company. We only have one in that sector. We have 3 of them, so we want to add to that. It's not really quite textiles, I would call them. Not quite.
Is that why it's crossed out on the list here?
It's crossed out, yeah, because it's not just the numbers that you see on this spreadsheet. It's also because of what you see in their balance statements. They don't look very good. They're not bad. They're not awful. I mean, I've seen a lot worse, but they're just not like, hey, give me something positive. Give me something to latch onto and we'll buy them. But they're just not there yet. I think, though, based on the latest financial report that I looked at, they're close to their bottom. or at least they're close to coming out of their bottom because they've been just languishing for over a year now. So we didn't buy them for that reason. It's the same reason why we do not look at REITs, at least not yet. We're waiting for at least 2 consecutive financial reports that show that they've turned the corner.
Yeah, and just because a stock doesn't look bad or maybe even looks good doesn't mean there aren't better stocks out there that you should buy instead.
Right. So next on the list, we bought this one, Johnson & Johnson. Now we've got 2 pharmaceutical biotech giant companies, Merck and Johnson & Johnson.
And now we can't buy any more unless we sell one.
If we go by our rules, we can't. I have a couple rules, 2 per sector, and then the other one I try to do is never try to short a company, despite like all the Nvidia and the Teslas. Like, oh, I could have made so much money. But
What a shoulda, but you didn't.
The guy who mentored me a long time ago said never do it, and the one time I was wrong, it would have been a really bad thing. So I'm glad I listened to him. But I don't do it. So we bought Johnson & Johnson. All of their numbers looked amazing. You could even see on this spreadsheet here, everything looks good. And they're a pretty safe company. They are trading relatively low compared to their 52-week high. So they're not at the bottom, but they're not doing great either as far as like what they've been doing for the past year. So good time to jump in. So we jumped in. Next one on the list, Kellanova. Kellanova used to be, like, people might know them as Kellogg's.
Yep. Good old Battle Creek, Michigan.
Yeah, they divested and like branched off into a whole bunch of different businesses, and that's where Kellanova came into play. And that was a few years ago. Since then, they've been kind of adrift in acquisitions and company transitions, and it shows up in their balance sheets when you look at the finances of the company. They're not really like, I mean, just look here at their numbers. Only recently, their net income quarterly looked pretty good, but everything else is kind of flat. That's pretty typical of the food industry. I mean, you don't ever see that really violently go up and down. It's pretty status quo. The reason why they're on this list is because they've been very humdrum, and I think they're coming out of all of the transitionary stuff, and they're finally able to focus on what makes them money. So we're probably going to see them on our spreadsheet again and again until it looks like a good time to jump in. But for now, nope. Which brings us to Kimberly-Clark. Kimberly-Clark. They just look good. Everything looked good.
Yep. We bought them before. We're buying them again.
Buy them again. I couldn't buy as much as I'd like. If you do not have a large position in Kimberly-Clark and you have a whole lot of other stocks and you want to leverage it out, do it. Kimberly-Clark right now looks great. Everything on their numbers look good. Their profit looks the projections look good. The forward EPS looks good. The forward P, everything looks good for these guys for now. So we added only 1,000. I wanted to add more, but I couldn't because it'd be overweight in this portfolio. So we bought that one. The next one on the list that looked pretty good, in fact, it looked amazing, was Procter & Gamble. So Procter & Gamble, these guys, everything, like net income 5 years, 300% almost. The cash flow quarterly, cash flow 5 years, everything looks good with their profit margins, the products that they sell. It's a relatively safe defensive company, very similar to Johnson & Johnson in some aspects of the business. But for now, we just decided that because they're trading just like Colgate, they're at their 52-week high. It's like, no, we got to wait. It's got to be a better cost basis right now. So we'll keep them on our list, but right now they're trading too high relative to their past. That does not mean that these guys will not go through the roof in the next year and that will be wrong and saying, well, I guess the trolls are right. But for now, the cost basis didn't seem right. Good company, just not yet.
All of these are good companies, really. You're basically buying the Dow Jones Industrial Average right here.
Yeah, pretty much. That's what that's what the spreadsheet for this month is.
Which isn't a bad thing. I mean, they're good companies for a reason. And people who get down on other people for buying the dynasty or aristocrats, it's like you're just buying an aristocrat. And yeah, there's a reason for that. Just because they're good, solid companies that are just going to give you dividends over time, forever.
Big dividends. In fact, we're at $115 a month now. It's pretty good.
Up from 103.
Up from 103. That's right. So the nice thing about this, we've got a monthly check that comes in. It's pretty predictable. It's based on products that people have to have. So I don't lose any sleep. We don't lose any sleep over whether or not these companies are going to pay us.
All right, there you have it. We are doing these every single month. And so you'll be sure to subscribe to the channel if you want to stay up to date on what we are doing, as well as check out the other videos. We're always tackling pretty important financial topics. So go check those out. Watch this video next, and we'll see you there.
If you find value in this, go ahead and like and subscribe.